Hello, everyone. Welcome to a Wall Street from Main Street podcast. My name is Mo Daoud, and today's special guest is Jim Bruce. Jim Bruce is the producer, writer, director of the documentary Money for Nothing, Inside the Federal Reserve. Now, Jim has been a student of the financial market for many years and began writing a newsletter in 2006 warning about the oncoming financial crisis. He short traded in 2007 and 2008 and helped finance a significant portion of Money for Nothing budget. So, Jim, thank you for joining me.
Thanks for having me.
Now, for our listeners out there that never heard of you, let's talk about your background. What made you decide to start a newsletter before the financial crisis, and how were you able to predict the oncoming financial crisis? Were there people that you were following carefully, that like Jim Rogers or Mark Farber or other well-known investors that are predicting the crisis as well?
Yeah, I was reading different people. I was a fan of Jim and Mark. Some of the people in our film, I was also reading people like Jim Grant and Jeremy Grantham, Gary Schilling. My background has only been working in the film business, but just as someone with a small bit of savings, trying to figure out financial markets, I kind of got drawn in during the late years of the tech bubble. It was the first time I ever had any money to invest. And I kind of rode the roller coaster up and part of the way down. Luckily, I didn't ride it all the way down. But that was sort of my introduction to how crazy financial markets could be. And I think we've really lived in an exceptionally unusual time for financial markets, kind of from the mid-'90s onward. And so just as someone with a little bit of savings trying to increase it, I sort of took an interest in the Fed, and in the early years of the 2000s when they were lowering interest rates at that time to sort of combat the stock market crash and fueling the housing bubble, I sort of started scratching my head and really looking in particular at the Fed and looking around for people who had a different take on what was going on, and that's where I came across a lot of those economists, some of whom are in the film, some of whom aren't. But who were really saying, in the middle of the housing bubble and the credit bubble at that time, that we had some big problems and they weren't going to end well. And I really started thinking about the Fed at that time, and it was sort of years later in the wake of the crisis that it occurred to me to sort of make a movie about that. I guess I should circle to 2000. You had asked, what got me writing a letter. So it was really, reading, these different opinions from people, warning about what was happening in 2003 and 4 and 5 and 6, and sharing those ideas with other people, in conversation at parties or at work or wherever you might strike up a conversation with someone. That I eventually decided to start putting the things in a little email newsletter to family and friends. Just sort of putting out there, starting in late 2006 and kind of through to 2009, at first a warning about what was coming, and then I think it was in either November or December of 2008, I kind of switched perspectives and then said now's actually a good time to start, taking some risk and buying some things.
So what was the reaction when you started telling people about the oncoming financial crisis? Because you work in a Hollywood industry, and that's known to be a liberal community.
Yeah.
When you start talking about the Federal Reserve housing bubble and oncoming financial crisis, did you hear crickets in the background, or did you able to gain some interest from people?
It's sort of human nature. I mean, I think it's the reason we have bubbles is that people have short memories. At that time, Los Angeles actually had a big housing boom in the late 80s that sort of went bust in the early 90s, and things were rocky for a while. But by the mid-2000s, sort of everyone had forgotten about that, and everyone, people have short memories. So most people I talked to when I said, there's risk in the real estate market and the stock market, they just kind of shook their heads. They didn't quite understand, how that could be, or they'd say, well, real estate always goes up, how could it not go up? And, it was hard. It was hard to, some people, didn't listen, some people did. But I think, that's the nature of people, especially especially in America. I think we're optimists, and we tend to have short memories. So, one of the things that I got interested in trying to understand financial markets was looking at history and seeing that bull markets come before bear markets, and that there are cycles. Everything moves in cycles, and I think to the extent that you learn about history, you start to realize that things happen again and again in similar ways. So I think that's sort of what drew me in. I think also as a filmmaker, the human nature side of the story of how people behave in markets, and also the human nature involved in the Federal Reserve. I think my perspective at the time was that Alan Greenspan was sort of really out of touch, and filled with a fair amount of hubris. He really thought he could see what was going on in the economy, and he could guide it by changing interest rates, and he really thought he was doing a great job until the entire financial system imploded. And I think hopefully one of the lessons of the film is that the Federal Reserve officials and policymakers, just like the average person, could really benefit from learning about financial history and thinking about human nature, and and maybe being a little bit more historically aware with what they're doing.
Right. And it seemed like you wanted to tell a story regarding the financial crisis, and it really focused around the Federal Reserve. And that's important because if you look at other books and documentary, like the documentary that won an Oscar with Matt Damon, what was the name of that movie?
Inside Job, yep. That was
Inside Job. Yeah, that was a good documentary, but they hardly ever mentioned the Federal Reserve and their role in the financial crisis. And I think they laid the foundation for the financial crisis. So let's talk about that movie. Why did you decide to create a documentary on the Federal Reserve?
Yeah, I mean, so as someone who had been sort of writing these emails telling people to try to reduce their exposure and their risk, going really before the crisis came on. And as the crisis was unfolding, I did begin to think, well, I'm a filmmaker. I could make a film about this, and I was thinking about, different angles that I could take. And it was really when the Fed actually announced quantitative easing in December of 2008. That was the sort of the signal to me. I thought, okay, here we go. This is going to be how the crisis ends, because the central bank has really promised to backstop everything. But already sort of at that time, I was thinking about kind of where we wound up in recent years, where there was a downside to the Fed sort of bailing everything out. So I really felt like the Fed was the center of. I also felt the Fed had really gotten off without being held accountable for their role in creating the problem in the first place. So to me, lower interest rates in 2001 and 2 and 3 and 4 really fueled the bubble in a direct and sort of easy to see way. But I think economists in general and investors, again, they sort of have short memories. I think by the time the crisis came on, the Fed sort of acted as if this was something that just happened out of the blue, that wasn't connected to their policies. So in making the film, I really wanted to connect the Fed's earlier policies during the bubble and in the years leading up to it with what happened in the financial crisis, and hold them accountable for that. And then I also wanted to sort of question whether the Fed bailing out the system, as they certainly did, was a good idea in the long run. I think in the short run, it is a good thing the Fed prevented the total collapse of the financial system, which I really think they did in 2008 and maybe early 2009. But then as you move into 2010 and 11 and 12 with, quantitative easing 2 and Operation Twist and then QE3, I think the Fed has really encouraged the same kind of risk-taking that led to the financial crisis. So my big view has always been the Fed hadn't really learned the lessons of the previous crisis, and they were sort of setting the stage for the next one. And the sort of tagline we have on our DVD for the film, and which we had in our poster when it came out in 2013, was the first film about the next crisis. And that's really what I wanted to make, was a film saying, okay, the Fed saved the system, but now are they just setting us up for another big problem by encouraging all this risk-taking with lower interest rates. And I think we've really seen that become, I think, more apparent to more people that we have some problems in the high-yield bond market and I think in housing in some areas, again, it's pretty bubbly, and I think definitely in the stock market, we're back into, yet another bubble situation.
Ever since the crisis, the Federal Reserve has grown in popularity, in good ways and bad ways. And the reason for that is because the Federal Reserve pretty much guides the economy up or down. I mean, they could come out tomorrow and say they're going to raise interest rate to 10%, and then the market will start crashing.
Yeah.
So that's how powerful they are.
Yeah.
Then also we have people like Ron Paul that's educating the public about the Federal Reserve, their role and their function, and people, especially younger adults, are starting to notice that and realize that, because mainly they're the ones that are struggling in the economy right now. We have people that are graduating, and the class of 2014 and 15, like 80% of them can't find a full-time job, and they're doing their homework thanks to the internet as well. It's closing the Federal Reserve. So are you surprised of the popularity of the Federal Reserve has grown?
Well, and again, that's one of the things I wanted to sort of work against with the film, was this idea that the Fed, I think the Fed is sort of viewed as the savior. Ben Bernanke, was on, he was Time Magazine's Man of the Year, I think in 2010 it was. There was a big cover in the Atlantic Monthly, Ben Bernanke as the hero, wondering why some people didn't like him, or not everyone thought he was a hero. And I think, there's two sides to the story, and I feel like the side that wasn't being told was the Fed's role in creating the problems to begin with, and then also really, to me, the biggest concern is the sort of path the Fed has put us on by continuing, in my view, and we sort of lay this out in the film in more detail, since the late 90s, I think the Fed has continued to try to rescue markets and the economy with lower and lower interest rates, and they each time they've had to lower interest rates for a longer period of time and keep them at a lower level, to the point where now we've been at zero for almost 6 years, and they're not sure they can even raise them. And to me, there's no real end game to the Fed strategy. I think they've done that, and it's maybe in the short run, it's pushed up stock prices and housing prices, and maybe created a little more economic growth than we might have had. But there's going to be a big cost for that, and that's that prices are at unsustainable levels. Prices aren't moving. The stock market's not going up because the economy is growing really rapidly, and corporate earnings are growing really rapidly right now. Earnings are actually shrinking, but because interest rates are so low, it's propping up prices. So I really wanted to trace the history of the Fed's role in the economy, show how it's been expanding dramatically, sort of with each crash, and then the question, well, what happens after the next crash? Because we're at a point where the Fed, really can't lower interest rates again because we're already at zero. And to me, that's not a sensible way to manage the economy, and so I really wanted to sort of point that out. I think it's hard. Human nature is when there's a big boom, people get drawn in by it, and they sort of don't want to hear, oh, there's a problem with this. People don't like to think short term, long term, and they get drawn in by short term, benefits, and they don't look at the long term costs of policies. But I think to me, it's just I felt like it was something that people needed to hear about and be warned about, the same way the financial crisis was something people need to hear about.
Now, one of the main functions of the Federal Reserve is to give guidance on what they think the economy will do for the next quarter or for the next few years. And so far, they've been terrible at it. I mean, if you look at before the financial crisis, you had Ben Bernanke going on CNBC saying, oh, there's no housing bubble.
Yeah.
Everything is fine. Why do you think the Federal Reserve has a poor track record for predicting the economy?
Well, that's another thing we really go into in the film is, from my perspective, the problem is that the Fed, is now almost exclusively made up of academic economists who have never really worked in the private sector, don't have a deep background in markets, even though their policies have huge effects on markets. Don't have, a lot of experience, with businesses or with, with how the private sector actually works. So I think sometimes there's a tendency for these essentially, academic economists to be sort of out of touch with the real world. And I think that, financial crisis was the perfect example of that. The Fed officials were praising, the economy and the financial system right up to the point where it completely unraveled. They did not see it coming at all. Whereas, some of the people who are in the film, people like Jeremy Grantham, Jim Grant, Gary Schilling, and others that you mentioned, they were saying there was a problem because they had a background in markets and they had a sense of historical perspective, and they weren't coming at it from a academic sort of mathematical background. And so we point that out in the film that the Fed really has to be more, if they're going to be a major influence on the markets, which I would argue they shouldn't be as big of an influence as they've become, they really should make it. But if they're going to do it, they should really try to understand markets better and try to see the risks that are out there in markets much better. But they have a really bad track record of doing that, and that sort of brings you around to this idea that the Fed shouldn't have the kind of role that it does have right now. They shouldn't be such a powerful influence. They shouldn't, in some ways maybe be able to hold interest rates so low, for example. During a time when we've had economic growth, we've had a huge boom in some areas. To me, is sort of absurd that the Fed is still at zero. But they're there because their sort of academic perspective tells them that that's what they should do. But again, I think people who are savvier in markets and in investing and in business are, there's lots of people calling out and saying, hey, they've done this too long. There's going to be another, there's more problems down the road.
I definitely agree with you on that. The Federal Reserve is made up of mainstream economists that follow the theory of John Maynard Keynes and what he thinks how the economy should perform. And then also, you talk about the market and economy. It's a very complex nature, the market and the economy, yet it's not hard to figure out when things are not going right in the market or the economy, even though it's a complex system to try to comprehend. I mean, if you can just do your homework a little bit on the internet and talk to people, you can sense that there's something not right about the economy and market. So it's not hard to do that. But yet, the Federal Reserve used the complex mathematical model that they create to try to predict the economy and where it's going, and yet it failed.
Yeah, to me, what's really been missing, especially since the sort of later years of Alan Greenspan at the Fed, because I think the thing we document, we look at 100 years of Fed history, that there were different times. We look at Paul Volcker, who came in 1979 when inflation was at 13%, and everyone at that time thought the U.S. dollar was doomed. The U.S. government is not going to be able to pay its bills back, and there was definitely a sense at that time that the system was falling apart. And I think Paul Volcker was a Fed leader who got it right, who I think had a background in financial markets and markets in general, and was willing to take steps that hurt in the short term because he raised interest rates very rapidly in the early 80s. But they laid this foundation for huge growth and benefits that followed. So in our case, the Fed leaders aren't always like this, but I think especially since the latter years of Greenspan, there's been a lack of sort of common sense at the top. Whether it was Greenspan towards the end of his career or Bernanke early in the crisis, I think common sense told you in 2005 in July that there was a huge housing bubble and they were in the middle of it. But Ben Bernanke, was looking at academic papers and saying, well, there's never been a bubble before, so there can't be one, So he wasn't using common sense, and I think that is historically that's been a problem for Federal Reserve officials. I mean, what we're asking them to do is very hard, to try to manage the economy. But if anyone's going to try to do that, they definitely need to have economic training, but also just a certain amount of common sense. And I think I think that's really been missing.
Now, you interviewed all these members of the Federal Reserve Board, such as Janet Yellen.
Yep.
So I want to ask you, what surprised you the most about the members of the Federal Reserve Board after doing the documentary? Is there anything that stick out to you after?
Yeah, I mean, a lot of times, the film is very critical of the Fed, but I certainly had read a lot of criticism of Fed policy in the years going up to the crisis, and I felt like it wasn't really having a big impact. So when I was setting out to make the film, it was a real goal of mine to include Fed officials as much as possible in the film. And I think one of the things that people are sort of shocked or surprised by when they see the film is how much criticism of the Fed, actually comes from Federal Reserve officials themselves. I think not all, but a lot of Federal Reserve officials, were willing to go on camera and admit that the Fed had actually made some really big mistakes, during the bubble and as it was unfolding. And so I think that's a positive aspect of the Fed, is that compared to a lot of other government organizations which never apologize for anything, I don't think the Fed's really apologized for their role, but they have examined their policies to some extent. I don't think they've really learned, but I think they are willing to be critical of their own organization, and a lot of them went on camera and were willing to talk about the Fed's role. And I think that's a positive thing. I'd like to see more of it. I think, to me, what I learned from meeting these people is that they are in a very difficult position because Congress has passed the Federal Reserve Act. It's been amended so that it's in the law that we ask the Federal Reserve, the central bank, to create full employment and price stability. And by asking them to do both things, it's really hard. If Congress asked me to create full employment, I might be tempted to say, oh, well, let's print money. That's the one tool the Fed really has. So they tried to use it, even if it doesn't really, as we've seen, I think, in recent years, it doesn't really translate to faster economic growth, lowering interest rates the way they have. But I think there's a lot of challenges that they face, and a lot of it is baked into what we're asking as, the people of the United States and the Congress of the United States. We're asking the Federal Reserve, in my opinion, to do things that they're not really capable of doing. We were essentially asking them to make our economy grow faster. And to my mind, since the late 90s, the way the Fed has tried to make the economy grow faster has been to foster these repeated asset price bubbles. And sometimes it's been in the stocks, more stocks than houses, sometimes more housing than stocks. It's gone into different areas because markets are, unpredictable, and the Fed can't really control how their policies impact the economy. But I think, to me, that the downsides have greatly outweighed the upside, and I hope the Fed will learn from that. I hope, Congress will learn from that. I hope people who are watching the film will learn from that.
Did you sense unevenness from the Fed official about what's going on in the economy right now? Because it seemed like they used almost all the tools and ammo to try to ramp up the economy, and yet all we see now is a stagnant economy with multiple bubbles popping up throughout the economy. In the debt bubble, housing bubble reinflated, college bubble, and the debt bubble.
Yeah, I don't think. I mean, again, to me, it's a small improvement, but I do think there has been a little improvement at the Fed. That, for example, during the height of the Greenspan era, I don't think there was any real self-doubt, or any. I think Greenspan really believed in his policies. I don't really think he thought things could go wrong. I think he was completely surprised by what a huge mess he ultimately left behind. And I think we've seen that in testimony, some of which is in the film, where Greenspan, really does actually admit that he had no idea things were going to get as bad as they did. So I think the Fed does question itself more today, and I think, the economy hasn't grown the way they're hoping it would have. And so I think, and there's a number of officials, who are in our film, who are current officials, who have been saying we should be ending quantitative easing. We shouldn't be doing some of the things we're doing. So a number of the people in our film have been voting against Fed policies in recent years, in some cases repeatedly. But I think there needs to be more questioning of what they're doing. I don't think there's quite enough. And I think, in the case of Janet Yellen, I think she really feels like she doesn't have any other choice, I think, is how she views it, than to use the policies that she has as a central banker, and that's, for example, right now to keep interest rates at 0% for a longer period of time. And I think she's taking the wrong lesson, I think, from recent years. I do think it's a slight positive sign that the Fed does question itself now a lot more than it did 10 years ago, maybe in 2005. But I think they have much further to go. My big concern is that we'll have another crisis before the Fed can sort of, correct any of its policies, and the Fed won't have the ability to respond the way they did, because we're already at zero. So what is the Fed really going to do? And asset prices are way out of sync with the economy and with people's incomes in most places. So I don't think the Fed has a lot of ammunition to fight against any kind of crisis or recession even that might be around the corner.
Yeah, the Federal Reserve has become a giant hedge fund, so to speak. I mean, their balance sheet is over $4 trillion, and it continued to go up, and yet the economy has not performed as well as they predicted.
Yeah.
So we have a lot of people out there, like people from the Ron Paul camp and Libertarian Party, calling for the end of the Federal Reserve, and we have other people calling to expand the power of the Federal Reserve. So where do you think need to happen with the Federal Reserve? Do they need to be reformed, or do they need to go away?
It's tricky. In a sort of perfect world, I sort of definitely believe in markets, and that markets do a lot better job than people with PhDs in economics in terms of setting interest rates and things like that. So, on a personal level, I think I definitely sort of question having a central bank. But then the film takes a slightly more practical view, and that, from my perspective, is that we have a system that is now completely and utterly dependent on the central bank, and I think that's a bad thing. But when you say, okay, let's end the Federal Reserve, it's really hard to imagine how do we go about, given how the Fed is the most important factor right now. They're the biggest owner of government bonds, U.S. bonds in the world. They own more than China, more than Japan. They're buying up mortgage-backed securities. They're the biggest influence on the housing market, which is, has this huge impact on our economy. They're the biggest influence on the stock market. So our economy is entirely based on central bank policy right now. So to me, it's hard to imagine what the path to simply ending the Fed right now would be. So what I sort of call for and argue for in the film, and it's one that a surprising number of senior Fed officials actually agree with, is that the Fed needs to exist right now, at least in the near future, but they should take a much more limited role. They shouldn't be trying to directly talk up stock and housing prices like Bernanke did, and we have it on film. After a stock and housing bubble, we have the senior official calling for higher stock and housing prices to make things all better, which almost seems absurd. But so some of the officials say that all the Fed can really do, they do have the power to control inflation. They do have the power to promote financial stability. I would argue that they're doing the opposite by promoting these bubbles in recent years. And so these officials say the Fed should reduce its role. They should do less. They should focus on things that they actually can control, like inflation and broad regulation of the financial system, and they should back away from trying to micromanage the economy with interest rates and trying to speed up economic growth with these huge booms that we've had. So that's sort of where I fall. It's kind of splitting the hair a little bit, but to my mind, right now we need. It's hard to imagine getting rid of the central bank and not having our system, collapse once again. But to me, the best thing would be for the Fed to vastly reduce the scope of what it's trying to do, and to allow market forces to drive a lot more things, to have asset prices be driven by, the economy, not by what our central bank is doing. I think one of the most interesting things of the years after the crisis is how disconnected really, the financial economy, where everything is booming and has been for years, with the real economy. So I think people should take that as a sign that the Fed policy isn't really working. That they are. I think the Fed really is honestly trying to stimulate the real economy, but because they're a central bank, what they do has a big impact on financial actors and banks and hedge funds and the stock market, and it's not all their stimulation, all the stimulus they're offering is not really translating to economic growth. So I think that's what Charles Plosser was the head of the Philadelphia Fed, Tom Honig, who was the head of the Kansas City Fed, Jeff Lacker, a number of who was at Richmond Fed, a number of the people in our film who are senior Fed officials who are voting on interest rates, in many cases voting against quantitative easing. They're the type of people who are saying the Fed can't really influence the economy that much. They shouldn't be trying so hard, especially now that the crisis is, at this point, 6 years ago. It's time for them to let the economy operate with market forces steering it and guiding people, and not these sort of all-powerful central bankers.
One of the main criticisms on the Federal Reserve is that it seems like their policies and the stuff they do seem to only benefit Wall Street, while people on Main Street, the middle class, are getting squeezed. We're seeing middle class shrink in this economy due to high inflation and high unemployment. So a lot of anger and frustration toward the Federal Reserve is due to that, which is understandable, as you may agree.
I agree. Yeah, I think we point that out in the film that if you look at the years since 2009 or 10, if you look at luxury retailers, for example, their stock prices and their earnings are through the roof, whereas the average retailer, places like Walmart or places that regular people use to shop and buy things, it's the exact opposite. It's kind of a sideways thing. So the economy, since the crisis, the Fed has, conducted, totally unprecedented policies, and the net result has really been helping out the wealthiest, helping out the financial system, subsidizing, to my mind right now, especially pretty risky behavior in the bond market. Mergers and acquisitions are going gangbusters because money is still so cheap right now. And so, it's the Fed has been helping the rich, and to the extent there's any, cost that we've seen so far since the crisis, it's been, higher inflation, which hurts the poorest people and the most, the elderly, the young, the people who are most sensitive and vulnerable are getting what cost there is from the policy, and then the wealthiest people are seeing all the benefits. And it's created, I think it's added to income inequality and especially wealth inequality in our country. We have some statistics that are really hard to believe, but they're true in the film about, how little of financial wealth is controlled by, anyone besides the top 10% in America. I forget the numbers, but they're in the film, and it's sort of shocking. And the point I would make in the Fed's defense is that they're actually not, I don't think, intending to help the wealthy. I think some people think the Fed is strictly, these sort of, evil, cynical people who are just trying to help the banks and help rich people, and they don't care about poor people. I think Janet Yellen actually does care about the average American, but her view is that she needs to stimulate the financial system in order to try to help the average American. And I just think it's not getting through. And rather than learning from that, I think she keeps trying to do the same thing over and over. So it's my hope that with the film, should we have a next crisis, we'll be a little further along in learning some of these lessons, and that really, as a country, we learn that it's not such a good idea to completely rely on your central bank and these big asset price booms to drive economic growth. That we should allow, sort of supply and demand and productivity and all the things that sort of made us a great country to lead us forward, rather than simply pressing buttons and printing, trillions of dollars at our central bank.
And that's a great point. So she meant well, but her policies has a lot of unintended consequences, and it's not working out for the average American.
Absolutely. And one of the tricky things in Janet Yellen's case is really she doesn't have the ability to, the central bank, they can't write a check and give it to poor people. I mean, maybe they should, but when they conduct policy, they're buying and selling bonds from these huge institutions. In many cases, who are front-running them, and traders and hedge funds. So that the Fed, as a central bank, they really don't have the ability. Jeremy Grantham is great on this. They really don't have the ability to impact economic growth very much, and these huge booms that we're seeing, have a smaller and smaller impact on economic growth. So yeah, it's like she doesn't really have the tools to help the average person. So maybe to some degree she should, maybe not be trying.
Right. So what is your outlook on the economy? Do you think another financial crisis will really wake people up on their Federal Reserve role in the economy? Would that be the final nail in the coffin for the Federal Reserve?
I do wonder that, and I do think, to me, people losing faith in our central bank, if that's the end result of this long series of bubbles that we're in, I think some people in the Fed crowd would say, great, then we can start over. But I just think as a nation, we're going to suffer so enormously if that's what it comes down to. If that's where this ends with taking it to the final limit and people losing faith in our currency, for example, because we just keep printing money for years and years and years to come. So I'm hoping we don't have to go that way and sort of run the system into the ground. I'm hoping we can sort of try to course correct beforehand. I'm not sure it's going to happen, but sort of my hope. My concerns right now are that we have done the same exact thing that the Fed did really in the early to mid 2000s. We've created a bubble in all kinds of assets. Back then, it was primarily real estate and mortgage-backed securities and other things like that. I think right now it's more in areas like the stock market and certain areas of corporate debt, especially a high-yield, riskier credit securities. So to me, there's a great amount of risk right now, and what I worry about is the Fed. We're sort of in a cycle where right now the markets believe the Fed is sort of all-powerful. When the stock market has been so strong in recent years, and I think you can't help but think that's because people have the sense that the Fed is backstopping it, and the Fed won't let the market fall. But if you look at 2000 to 2002. The Fed was cutting interest rates, well, especially 2001, they really began cutting interest rates. They cut interest rates really rapidly in 2001 and 2, and the market still dropped like a stone. And if you look at, the crisis, the market topped in the fall of 2007, and the Fed was already, started cutting interest rates in the fall, and they cut them down to the bone, over the course of the next year, and the financial system collapsed while they were doing it. So I think right now one of the big risks in the market is people misjudging the Fed's ability to prevent a large stock market correction or a bear market. I do think keeping rates at zero, as the Fed has done, has definitely pushed off probably some economic weakness we might have had in recent years, or some, we might have had bigger stock market corrections if they hadn't done that. But to me, I think investors are really pricing things as if they can't go down right now. And I think history shows that as soon as people start doing it, that theory gets put to the test. And I think in the end, the Fed won't be able to manage the next crisis very well at all, because there's a decent chance by the time we have our next recession, they may not have raised interest rates at all. So they won't have the ability to lower them. So yeah, I'm definitely, I don't know about the timing. It's much harder to predict in the housing market, and the credit crisis that came, last time. That was easier to see what the trigger was. I don't know what the trigger will be this time, but I worry that people losing faith in the Federal Reserve, could lead to some pretty drastic activity in the stock and bond markets.
And the audit the Fed bill is becoming more and more popular around America and within Congress as well. So hopefully we'll see that try to gain traction and hopefully get passed, because I really want to see where they threw all that money in the economy.
I think, to me, that's one of the, to me, the most important things, if people who are concerned about what the Fed does and its impact on the economy, to me the biggest thing that needs to happen is the general public needs to be educated about this, and then they need to influence their congressional leaders, because a lot of people are frustrated because the Fed seems all-powerful, but the Fed was created by Congress. We've had central banks before. We've gotten rid of them before. Congress got rid of them. Central banks, twice earlier in our history. And I don't necessarily think right now we need to immediately get rid of the Federal Reserve, but I think Congress could really change the mandate that the Fed has, for one. They could hold the Fed much more accountable. They could shine a bigger spotlight on the Fed. But to me, one of the big problems is I don't think when I look at congressional testimony with, the Fed is required to testify before Congress a certain number of times a year. And when I watch those hearings, I'm always pretty disappointed in most of the questions. Some people do a pretty good job. You mentioned Ron Paul, and he's pestered the Fed quite a bit over the years. But in general, I think most, congressmen and women don't do a very good job of holding the Fed accountable, don't really understand the Fed's role, don't see the risks that the Fed is creating. And so then the sort of democratic, and the general public doesn't see it, so then the democratic system doesn't work. We really have to be educated about our government and different agencies and what they're doing in order to get better policies. And to my mind, the clock is ticking. I feel like there are a lot of risks out there. And the sooner we start to shine a spotlight on Fed policy and watch them and hold them more accountable, the better the outcome will be for our economy and our system. I really hope we don't wait till we have another huge crisis and only then start to act.
Now, Jim, before I let you go, now you work in the Hollywood industry, and I want to ask you a question. I don't think anyone ever addressed this about Hollywood. Mm-hmm. Do you think Hollywood is in a bubble?
Is Hollywood a bubble?
It seems like almost every month I see a superhero movie, which costs a lot of money to make. I know that it's a very big budget. I was going to ask you what. Go ahead.
I was going to say, having worked on a couple of those, like I worked on The Incredible Hulk, the most recent one with Ed Norton, a couple of those kind of big, dumb blockbusters. I think there's definitely a superhero movie bubble. And I hope they start making some different movies, because I think people are getting tired of seeing the same outfits. I think celebrity culture is certainly in a bubble in our country as well. Whether it's the Kardashians or whoever. But I guess to me the beautiful thing about markets is I think when people make too many, superhero movies and they start getting boring, people stop going, and then Hollywood, I think, will respond to that. To me, Hollywood's a little bit like Wall Street in the sense that if something's popular, they make a ton of it, So if there's a pirate movie, and it does well, then everybody's trying to make a pirate movie. The same way I think Wall Street, when .coms are popular, Wall Street just starts IPOing every .com under the sun. And that's something, to me, the beauty is that markets can correct things like that, And I think markets eventually do that. My concern is that in the case of the Fed, since they have the unlimited power to sort of print money, there isn't as much of a check on them when they start making mistakes.
Right. Well, Jim, I'd like to thank you for coming on the Wall Street from Main Street podcast. If people want to buy your documentary, where can they go?
Our website is www.moneyfornothingthemovie, all written out, .org. And I also wanted to share that I put up a 20% discount. So for listeners to your podcast, if they type in the promo code Main Street, all those words written out, when they're checking out of our store, they can get a 20% discount on DVDs or Blu-rays, or we also have digital downloads of the film available on our website.
So Main Street spelled out, so Main, S-T-R-E-E-T.
That's right.
All right. Well, Jim, thank you for your time. I appreciate it.
Thanks so much for having me.